This is the CRE Weekly Digest by LightBox, a firm transforming the commercial real estate landscape by connecting every step of the CRE process with comprehensive tools and data. I'm Martha Kocher with our experts Manus Clancy and Dianne Crocker. For the week of December 9th to December 13th, investors saw stocks slide and treasuries edge up after November wholesale inflation came in hotter than expected. And in other economic data, consumer inflation ticked up from last month and weekly jobless claims jumped. Manus, Wall Street is coming off a mixed session with some record highs, but analysts are still expecting a rate cut when the Fed meets next week.
Well, a couple of weeks ago, when we spoke, I asked pretty openly, is the Fed blowing it? 50 basis points in September, another 25 basis points in November. We're seeing record highs, not just in stocks, but we're seeing it in crypto. We're seeing it in oddball artwork, like that banana taped to the wall. We are seeing it in home prices, and yet we've seen 75 basis points in rate cuts. We expect to see another 25 basis points next week. And that comes in the face of two reports this week, which were not terribly encouraging. CPI ticked up last month to this month. Yes, the number was in line with expectations, but it remains naggingly above that 2% threshold that the Fed aspires to. The core number, which excludes food and housing, was up 3.3%. I think the headline number was 2.7%. So that's the kind of number that gives me pause, that the Fed should not be too aggressive this week. Then we got the PPI number today, which is Thursday morning, and that was even a little bit warmer than what CPI was. So you have back-to-back days where there's evidence that there's still wood to cut on the inflation front. And I thought this was very interesting yesterday when I was watching Squawk Box during the post-Jim Cramer session, I guess that 10 to noon Eastern time window. You have Sarah Eisen on, and she was saying she feels like investors are bullying the Fed into making this move, that the Fed sees the data. By and large, the data has been better than anticipated for several months, yet there's a 95% expectation that we're going to see a 25 basis point rate cut next week. At the time, she had somebody on from Wells Fargo who was of a similar mind. He was saying, yes, it does seem like the market is trying to influence the Fed very hard for this next 25 basis point rate cut. And that's a little alarming. I do think the Fed has to continue to be very cautious with the punch bowl. And I think it's getting to the point where you have to say it's enough for now. Let's wait a couple months to see where these next 3 or 4 months of inflation numbers take us.
I think you're probably right, Manus. I think the jump in the Treasury definitely reflects some of the jitters coming out of this week's reports. And it's almost like choose which story you want to believe. Is it good? Is it bad? Is it 2 steps forward, 1 step back? I think it's clear that inflation is going to be a big part of the narrative as we turn the page to the new year. And a lot of the folks I'm talking to, their worst fear is something that Spencer Levy said on last week's podcast, which is, what if the Fed blatantly got inflation wrong? What if they actually move to raise rates again next year? I mean, imagine if rates went up in 2025 after we waited most of this year for them to finally come down for the first time. I think that would trigger a retreat or a re-retreat of capital to the sidelines. So hopefully that's not where we end up.
It's hard to square both sides of the market, especially considering who our audience is. On the one hand, 90% of our listeners are in the capital markets. They're in the CRE markets. They're lenders. They're originators. They're property owners, distressed asset, workout specialists, et cetera. They all benefit from lower rates, and they're all coming off a 30-month stretch where high rates have kind of broken their spirit, right? They've seen distress pick up considerably, an inability to refinance, property values fall. And for them, this drop in interest rates is very, very welcome. But for the rest of the economy, and especially on the short-term side, when you're talking about lowering floating rate debt, very important for some of these borrowers there. On the other side of the coin, the broader U.S. economy, I go back to what I said 3 minutes ago, which is so many things at record highs. The punch bowl is being consumed by people in crypto, by people in the home ownership market paying record prices for homes, in the equity markets. And I do fear that there may come a day next year where the Fed says, yes, we have to be more aggressive here. We're starting to see an uptick in food prices. Home prices are getting out of line. Rents are ticking up at an alarming rate again. So we will see. I hope the Fed gets it right, and I hope that they can do it in such a way that it benefits commercial real estate property owners and lenders.
Yeah, you and me both. Manus, did you see as of Tuesday, it sounds like the new pick for the Treasury Secretary gave some reassurances to Chairman Powell that he'll be able to stay through his term, which I think is through mid-2026. So sounds like Powell got a little job security this week.
He won't be going to the Walmart and putting his application in to be a greeter. I don't think Fed Chair Powell has that desire or that need at this point. But I think stability is important. I think that it would be unprecedented trying to remove the Fed chair. I think that that's an unnecessary fight for the president-elect to go down that path. It's not important. But going back to the market reaction over the last couple of days, we do see the short end of the curve and the long end of the curve moving in different directions. On the short end, people are anticipating, as I said, 95% expectation of a rate cut next week. That would push the Fed funds rate down into that 4.38%, that SOFR into that level around there, down 100 basis points over the last 3 months. But on the other side of it, the CPI and the PPI numbers this week pushed longer interest rates up. The 10-year hit a trough of about 4.18%, helped by the nomination of Bessent as the new Treasury Secretary, that he would be aggressively trying to reduce our deficits. The market cheered that. But since then, we've seen the 10-year move from 4.18% back up to 4.30 this morning. The yield was up considerably yesterday. It was up considerably today. And that's not what we want for CRE, for the CRE market. And that's really, I guess, what I'm talking about when it comes to the Fed, right? That if they drive short-term interest rates lower, which is the only mechanism they have, but that's deemed to be inflationary and it pushes longer-term interest rates up, it's a self-defeating cycle. You've erased whatever gains you were trying to make in reducing longer-term debt costs.
Regarding the CPI number, Manus, one of the things that we've talked about several times is the cost of shelter. It is still rising according to the last CPI number, but if you're a glass half full person, it's not rising as fast.
That is nice, right? We want to see the American consumer not overwhelmed by housing costs, whether it's single family ownership or multifamily. But again, we're talking about a bifurcation here. On the one hand, the U.S. economy can use a leveling off of housing costs. They could use a leveling off of the price of purchasing a home, of renting a home, of how much your monthly paycheck is consumed by shelter. Having that level off would be a good thing. But on the other hand, for commercial real estate types, modest growth, 5% increases in rent year over year is a net positive for the multifamily market. There's no doubt about that. It would solve a lot of problems that emerged in 2021 from buyers paying top dollar with inflated expectations for rent growth that have not come through, that if we were to get steady rent growth, a lot of those mistakes would be mitigated. Depending on which side of the fence you are on regarding inflation, the Fed's decisions, shelter costs, there are some people rooting for the Eagles, you might say, and some people rooting for the Giants, right? It's pick your side, and you're, depending on how it influences your life and your business and your holdings, you probably have different motivations for what you want to see happen.
And weirdly, cereals and bakery saw the biggest inflation drop since 1989. So Manus, what's your guilty pleasure?
I said this the other day that if we were to have a discussion about bakeries, we might have to make a whole entire separate 40-minute podcast about that. My first job as an 18-year-old was working in the back of the bakery at Tilda's in Rocky Point on Long Island, a spectacular bakery if you were a consumer. As a worker, not so much. No air conditioning and lots of heavy lifting of bags of flour and stuff like that. But always a big fan of the French cruller, the apple fritter, the cream donut, the Boston cream donut, the glazed crumb bun, any of those things. I could go through 6 or 8 of those in a day if my doctor would let me.
Wow. I thought you'd say something like Frosted Flakes or something.
No, that's for the amateurs. You got to go right to the bakery and get the fresh stuff right out of the oven. How about you, Dianne? What's your guilty pleasure in the bakery aisle?
I'm with you, Manus. Bakery over cereal any day of the week. I love a good Boston cream. I don't think any other donut is worth anyone's attention.
I would say there are very few things in the bakery aisle that I don't like. I would back up the truck if I could.
Well, now's your chance. Turning to the LightBox CRE Activity Index, we saw the number come down in November by double digits, and there is some seasonality to the number. So, Dianne, what part of it is a seasonal, normal part of what happens, and what was unusual? Yeah, it was interesting to see. We did talk earlier in our podcast in November about what we expected, and it's really not unusual for the index to go down a bit between October and November, and certainly that was the case this year. The index for November came in at 80.5, and that was 15.4 points lower than October, but it was 12.7 points higher than the same period last year. You know, one thing I did was I looked back, okay, well, what was the average drop between October and November? And typically the average is 14.7. So the 15.4 drop was a little bit steeper. And I would say that was probably a function of just the overall uncertainty reflected by the volatility and the 10-year Treasury as investors started to kind of assess the outcome of the Trump win in the November election and what that might mean for markets, you know. But as we were just talking about, it's been a pretty weird fall. Lots of conflicting signs across the board. I think the market is so desperate for good news right now. But what's interesting to me more so than that October to November drop was, okay, so where did we land versus last year? And versus last year, we were 12.7 points higher than November of 2023. So for me, I thought that was reassuring to see, especially because the data behind that uptick were double-digit increases in velocity across all 3 of the activity indicators that we look at in the index. So if you've not heard us talk about the index before, it measures velocity in 3 different elements of commercial real estate, all of which support transaction activity. It's showing that there were more property listings this November versus last. It's showing that we're seeing more commercial appraisals by lenders, and we're seeing more projects for environmental due diligence that precedes transactions. So, I think it's because since last November, a lot of the major impediments to deal making, rates were locked at high levels. Nothing was happening at the end of last year. The bid-ask gap was still huge. There was price uncertainty and not a lot of people putting properties up for sale. So Manus and Martha, I think those are all showing improvement. So there's obviously pretty good arguments in favor of optimism as the end of the year closes out. What do you think?
I would certainly agree that there's reason for optimism. Part of that optimism is that crises never last forever, and we're now 30 months into this downturn, the impact of higher interest rates. We do have the modest tailwind that interest rates are coming down. They're not nearly as high as they were at their peak when the yield on the 10-year was 5%. Animal spirits are growing, but growing modestly, right? I think people are not racing hand over fist with their cash to deploy money. They're being strategic and surgical with their purchases. That is what I think reality is for now. But I do think that for the next 6 months, this index is very much tethered to where the 10-year goes. That if we see the 10-year go from 4.30 today back to 3.5, we're going to see this index explode upwards, and we're going to see animal spirits take off. People are going to want to deploy cash. The numbers are going to make sense. Buying power will increase. Capital availability will improve. If we go back to 450, 475, something like that, I would expect the index to lag. That doesn't mean we're going back to late 2023. I think those days have come and gone. That was the trough of all negative sentiment at that point. I don't think we're revisiting that. But I do think that the level of enthusiasm we have for CRE is very, very highly correlated to that 10-year right now, and that will continue for the next few months.
Yeah, I think you might be right. I wanted to mention, too, that I reached out to a market friend of mine. Her name is Lisa Strope this week, and Lisa is the VP of Research at TA Realty in Boston. She's one of my go-tos for market intel, and her take, Manus, is very similar to what you just said, that the data might be showing a slowdown month to month, but that anecdotally, things seem to be percolating faster. And now that we've got broad signals pointing to a market shift, many of which you just mentioned, that the December data she thinks will show an uptick in investment sales activity in the final weeks of this year. So when the December index comes out based on that and based on, as you said, what happens with the Treasury, we'll see if my friend Lisa is correct.
This pivot could come very quickly. I'm hopeful that the new administration, they made some very lofty promises. This idea of cutting $2 trillion in spending, reorganizing our government workforce, things like that. If there's this opinion that they are succeeding, that they're managing to cut costs without being incredibly disruptive, and what does that mean? Cutting costs without making unemployment go higher because you've laid off so many government workers, or you haven't rattled elderly people by cutting benefits or things like that. If you do it in such a way which is responsible and you're really finding true government waste and you're saying, we've done this, our deficit is going to be $600 billion next year, not $2 trillion, I think the market reaction would be severe to the upside, as people would say, wow, they are making progress. They are making progress very fast. And this is going to accrue to the benefit of interest rates going forward. Can they do it? I don't really know. I'm hopeful. I'm a hopeful person that they could do it and do it responsibly. And if they do, I think the market will react favorably. But there's a lot of chapters to be written on whether they can, how much resistance they'll get from the American public, from Congress. Time will tell, but I'm hopeful.
Yeah, a lot of moving pieces. Someone else I like to touch base with, especially when the forecast is cloudy, and it certainly is now, is Ryan Severino. He's the chief economist at BGO, and he is the only economist I've ever heard who actually used the adjective bubblicious to describe the market. This was obviously years ago, Manus, probably 2019. But he's also the only one who last January predicted that interest rates would not go down until the third quarter. I put a lot of stock in what Ryan has to say. And Martha, this week, his latest forecast came out. Did you see that?
I did. He's such a great person to follow. He puts together really good analysis in his Holly Jolly Economic Update. Interesting takeaway, he sets retail up as having the best performance in the near term over some of the other property types. And obviously, a lot of that will continue to bank on how the holiday season unfolds in terms of holiday sales. Despite that, though, we've seen some stories of legacy retailers really struggle. And I'm thinking specifically of JCPenney and Macy's.
It's been a narrative that's been in place really for almost 10 years now, right? Since about 2015, when we saw Sears basically begin to unravel, the demand for your traditional department store has waned. We've seen during the bankruptcy cycle of JCPenney a couple of years ago, they closed 170 stores. Macy's, you can count on every year closing 10 or 20 stores. It's been the narrative for a long time. I think that the positive side of that coin has been that for many of these retailers, they do have really desirable locations. Some of their stores are really still terrific assets for them, not just for the real estate, but they still do attract great foot traffic. And they've spent the last 10 years right-sizing. Maybe there's more wood to cut for Macy's and JCPenney to get that right. But I do think the darkest days for those firms are over as it pertains to threats from e-commerce, people not looking to go to the shopping mall anymore. I think we've reached this equilibrium now where people are no longer talking about the malls that remain being obsolete. We've kind of right-sized. Yes, we'll see more that go away over time, but it's not the numbers that we saw from 2017 to 2021.
Agreed. There's a lot of exciting redevelopment happening in retail. And like you said, a lot of these retail locations that are being shed by, JCPenney, by Macy's and others are going to get picked up, and they're going to get a makeover in a way that makes them appealing to the folks that still do want to shop. I went to the Herald Square Macy's on Black Friday, and I did. It was a mosh pit. It was a mosh pit, Manus. I didn't spend $1, so maybe it was mostly people like me who were just there to drink up the holiday spirit and then did their spending online.
All right, let's talk about sales. And we've got an interesting dichotomy. We've got leaps of faith and some failures in the context of conversions and redevelopment.
I think the conversion story is one that really has had legs over the last couple of months. We had a conversation a couple of years ago. Darren King was one of our co-hosts on our previous podcast a couple of years ago. And he would always talk about the dog that will never hunt was taking shopping malls and converting them to distribution centers, industrial. And he was really right. Only here and there were people able to take aging shopping malls and turn them into something really profitable that had an alternative use. Some people at the beginning of this cycle thought the same might be true of this office to resi conversion story, that it was aspirational, but it would be hard to do. Just too much capital needed, too much brain damage to pull it off, a rezoning, a needing to really spend a lot of money when capital was hard to find and expensive. But I do think we've reached a point where you can say this is happening, that in every city you're seeing it take off, cities big and small. And it's good to see that these are leaps of faith, people saying that we can get that 20 or 30 or 35% return we want on our equity by taking this property, borrowing, redeveloping it, and moving it from obsolete office to new residential. So I'm excited by this. It's great. It's wonderful when people take these leaps of faith. It's really important for these cities that have oversupplies of offices, and I can't give enough credit to those that are taking these steps to do this. It takes a strong constitution.
Yeah, definitely. It's not for the weak of heart. And I do remember coming out of COVID, a lot of people said, look, there are all these articles in the Wall Street Journal about office to resi conversions, but it's not like flipping the switch. It really does require a lot of redesign, a lot of new infrastructure just to outfit individual units with with the things that they need, plumbing and whatnot. But it's an interesting trend to watch, because I think for this lucky subset of Class B and Class C office buildings, they're going to get a second act as buyers pick them up, maybe at pretty sweet prices with the intention of converting them into housing. And one other thing that Spencer Levy said that really stuck with me was, look, we have an affordable housing problem in the U.S., and the only way to solve that is to build more housing. So as we start to see local governments really do what they can to grease the wheels and streamline permitting and add incentives that help kind of make the math work out a little better for developers, we'll start to see more of these projects hopefully move down the runway a bit, which I agree with you is definitely a net positive.
So let's jump into some of the specifics.
Yeah, the one that's not terribly specific, I just want to bring out some of the data points here. This is the Wall Street Journal article that you referred to. Over 70 conversion projects with more than 10,000 units have already been completed this year in the U.S. That's a lot of conversions already. I was shocked at how many have been done in the short period of time since this has become a thing. But they said 309 projects are underway, and they list some in New York, Chicago, D.C., but also in Cincinnati, Phoenix, Houston, and Dallas. So a lot of things going on. We'll get into the specifics right now. In New York, Gary Barnett, who owns Extel Development. Gary is known for putting up some of those really big condo projects on what's known as Billionaires Row on Central Park South in New York. They've all come up over the last 10 years, 80, 90, 100 stories with views of Central Park. He puts up really high-end things. He's going to take the Disney campus on the west side of Manhattan. They say Upper West Side. in the real deal, but it's kind of like Midtown Westish, kind of the 70s and 60s. He's going to take that and turn it into a pair of residential projects at the former ABC campus on the west side. He spent $900 million to acquire the properties, and now he's going to spend even more money converting them. Elsewhere in New York, a lot of New York-centric stories. Isaac Chetrit has filed a conversion plan on the Stewart Hotel in New York. He's looking to flip that property from a shuttered hotel into 625 apartments. This is, if I'm not mistaken, it's Midtown Manhattan East, I believe. So those were two stories that I really enjoyed seeing. This one's a little bit more off the beaten path. It's not a redevelopment, but it is a leap of faith. In Irvine, California, the Irvine company announced that it's going to spend $24 million to revamp 4 offices in Orange County. These are properties in Irvine, Costa Mesa, Newport Beach. They believe the flight to quality is enduring and leaning in, spending money to improve the physical plants and the amenities of these properties will pay off. And so another case here of an unloved property type office attracting capital and a willingness for people to come in, lean in, reposition, and invest in. So I love these kinds of stories where people are really putting money to work to keep the commercial real estate market evolving, improving, and redeveloping.
But not all of them are good stories.
No, we do have a negative one here. It just shows that need to have a strong constitution. This last one comes to us from Chicago. The reporting here by The Real Deal. They talk about how the conversion process of 330 South Wells has gone a little bit sideways. This was going to be, or is, a pre-pandemic office to resi conversion of the property. The LG Group is the developer there. The loan, the CMBS loan that was initiated to help them pull off this conversion has gone to special servicing and is now with the workout specialist. So it just goes to show that not every one of these things is going to be a straight line from deploying capital, borrowing money, and executing. Some of these things will not work out, but I do think that by and large, the majority will, but some will go sideways. In this case, LG Group still has time to pull this off. The debt is with a workout specialist. We can be hopeful that they come to some kind of agreement to change the terms and give LG more time. But there'll be more stories like this before all is said and done.
Okay, let's turn to leases. We had a number of office leases that looked interesting.
Well, this is the same kind of thing that we were talking about just a moment ago, leaps of faith, people taking space at a time where work from home is still naggingly true, office demand is still low, and yet we have some firms really taking big swaths of space. So call them more leaps of faith, in this case, in the leasing category. So here's a few in short order. From The Real Deal, Amazon took 220,000 square feet of space in Mountain View. That's at 401 San Antonio Road. They are taking space that was previously taken by LinkedIn, subleasing that space from WeWork. So a positive story there where with Amazon eating up some of the vacant space in Mountain View. Original reporting there, by the way, I should say, is the San Jose Mercury News, another really good outlet for commercial real estate reporting in the Bay Area. Elsewhere in California, Snowflake subleased almost 800,000 square feet in Menlo Park, one of the largest Bay Area deals in years. This is also coming from The Real Deal. The firm will be taking 4 building offices in a campus that was previously leased to Meta. Wow, 773,000 square feet. In New York, SL Green landed a big renewal at 485 Lexington Avenue. There, Travelers Insurance has renewed 125,000 square feet on 3 floors, extending their lease there for 10 years. Heading south to Florida, in Orange County, Assist RX signed a deal for 55,000 square feet of Class A office space in the core Maitland Promenade 2 at 495 North Keller Road. The company will be moving its current headquarters from 2001 Summit Park Drive. That reporting from Biz Journals. Lastly, Hines announced that law firm Jones Day will be the first office tenant at South Station Tower. That's in Texas. This is a 41,000 square foot lease. And again, Hines developing this property was a leap of faith. This is not for the weak of heart, as Dianne said. You're building a tower on spec, hoping to find tenants. In this case, Hines rewarded with a 41,000 square foot lease to Jones Day, 15 years. The building should be completed by 2025.
One of the other things in addition to leases that we watch are just overall vacancies. And for anybody listening who might be wondering where the next opportunities are, I'll bring to the surface a BizNow article that came out this week by John Bannister. And it was about the impact of the Trump presidency on DC office vacancy. Roughly 52% of the federal government's leased office portfolio either has lease expirations or termination options between now and the end of 2028. It'll be interesting to see, I think, the Trump administration's handling of these expiring office leases will certainly have major implications for the owners of the commercial properties there, as well as for any investors or lenders. So, who knows? We could have developers swooping into DC and converting some old office space to multifamily. That's the first place I lived after college, and I think it still very much has appeal to 20-somethings, given, transportation. It's certainly a hub. So we'll see what happens.
I think that this is inevitable. I think the fact that the administration coming in is saying that they want to cut costs, very easy to not renew leases. In some cases, the federal government owns these buildings. I expect them, where the federal government owns them, they will be sold. So it is a very mixed bag, probably mixed more to the negative than the positive. Lenders on these properties have to be a little bit terrified that the leases are going to be expired. They will be 80 or 90% vacant. It'll be hard to sell the properties at values that will pay off that debt. Certainly very scary there. I do think that if you're even a property owner in that market that doesn't cater to the government space, just flooding that market with space is a net negative, which will push vacancy higher and demand lower. That's a problem. But I do think that there will be people picking up nickels on the sidewalk, buying these properties for pennies on the dollar and putting them into a conversion pipeline that allows them to be transferred. The one thing I fear about these offices, though, this was always one of the funniest terms I heard about DC offices, and it's so true, that their architectural design is brutalist, right? That they're just built for utilitarian function. And I'm not sure how much demand there is to live in a brutalist looking complex. We'll see. These developers are so creative. They manage to find amenities and put them in where you didn't think this was possible. So maybe even brutalist is redevelopable, if I said that properly. It'll test their creativity, Gene.
And our Did You Know from the week takes a look at the environmental site assessments for the second half of 2024.
Yeah, so I went back and I looked to see where the strongest growth in Phase 1 environmental site assessments could be found year to date. And it wasn't in the primary metros, some of which we've been talking about here today. It wasn't in New York City, LA, and Chicago, but it was in the smaller secondary markets like Minneapolis, like Cincinnati, San Diego, Columbus, and Charlotte. So those top 5 metros grew by an average of 25%. That's year on year through the end of November versus last year. And they grew by 25% compared to 5% across all primary metros that we model in the LightBox EDR Scorekeeper model. So it was interesting for me to see, and I think a lot of these smaller secondary metros are driving many of the stories certainly that we cover here in terms of sales, in terms of leasing, in terms of redevelopment. So I like watching the Phase 1 ESA activity at the metro level because it really is a reflection of the early stages of where CRE lending and investment is starting to pick up and the metros that investors have in their crosshairs.
One of the tailwinds some of these markets will have is, especially when you talk about Cincinnati or Minneapolis, is that the COVID period didn't coincide with enormous amounts of overbuilding and development at that time like it did in the Sun Belt, where you saw projects going up month after month after month. And I think that that will serve them very well in the years to come, that there'll be a little bit more white space for developers there than there'll be in some of the hot markets that have emerged since 2020.
Okay, a couple programming notes. Next week, we'll be reviewing the successes, setbacks, and surprises of 2024. And our predictions for 2025 will be dropping January 3rd, so you're not going to want to miss those. We did get a bit of a preview of 25 from our Spencer Levy podcast. And if you haven't had a chance to listen to that one, it's definitely worth a listen.
We certainly want to give a shout out to Deborah Morgan, who listened and gave Spencer very high marks for his interview. Not surprising. He's just so good at taking complex topics and boiling them down into things that we can all understand. And his side notes on making brisket were must-listen podcasts. If you haven't checked it out, that was one of my favorite moments of 2024. But thank you, Deborah, for reaching out and listening. I agree with you that was a really nice interview for us.
And Manus and Dianne, I know you're probably not finished your holiday shopping. So interestingly, our friend Ryan Sabrina, who we've talked about before earlier in this podcast, was referencing the PNC Christmas Price Index, which looks at what the gifts from the 12 days of Christmas would set you back in 2024. And apparently the items in the song would cost you about $49,263, up 5.4% from last year.
I have so many questions. How do you price out Lords of Leaping? Is that based on like rates for hiring a dance troupe?
You know, the thing that I never got was the partridge in the pear tree. I mean, I'm not a pear guy. I'm not that much of a fruit guy even, but, you know, it was, I don't know. None of those things sound that appealing to me. What about you, Dianne?
How about 5 golden rings, Manus?
There we go.
Who doesn't love golden rings?
Yes, that's a nice thing, and they probably will hold their value. Gold continues to go up in value. I have to go through the other 11 and see if there's anything in there that I can really go for. But this image of me, you know, hosting our Christmas Eve, we always have a huge Christmas Eve in the Clancy family, and we have 40 people. We have a huge party. We're now on year 33 or 34 of doing this. But as our family has more grandkids and nieces and nephews get married and they have kids of their own, it gets a little more crowded every year. You throw in, how many is it? 11 Lords Leaping or Maids a Milking? I don't know. There's going to be no room for anybody.
Well, sadly, the partridge in a pear tree had the biggest increase, 16%. But man, it's turtle doves, calling birds, swans, apparently unchanged from last year. So load up.
I don't know. When I hear of all those birds, I just keep thinking of all those pigeons in New York. And I'm thinking this is like one of those things that just doesn't make your day.
We'll have to see. Thanks to our producer, Josh Bruning. Please join us every week as our LightBox team shares CRE news and data in context. You can listen on any of your favorite podcast channels and send us your comments or questions to podcast@lightboxre.com. Thank you for listening and have a great week.
Let's go.